The hearing will come to order. I apologize for being a little late. Can we get the door closed back there? This is a very important hearing, and I want to say that I am very appreciative that through the hard work of a number of people, including my two Massachusetts colleagues who are here, and people from the regulatory field, but also people from the industry, we sometimes have a hearing to lament the bad state of affairs. Obviously, this is a situation where there had been problems. We rarely have hearings of self-congratulation, but I am pleased to note that the situation today regarding this looks a lot better than it did when we called the hearing, and I am very appreciative of the efforts of a lot of people, as I said, including those who were here, who were in leadership, and the industry that responded. But it's still important for us to go ahead, because we have been focused, understandably, as a Congress, in the executive branch, in the private sector, on the important questions of systemic stability. No one thinks this country is falling apart, but we are undergoing a degree of stress now that's having negative consequences far beyond what we would like to see. And trying to cope with them and then trying to put in place rules going forward that diminish the likelihood of a recurrence have been very important. There is a danger here, and I don't impute it to any one individual, but it's a danger for all of us. As you focus on systemic stability, investor protection can slip, partly because it's just not at the top of everybody's agenda, partly because there are, in some cases, conflicts. To the extent that you have institutions that have been weakened, the question of what compensation they give is going to be raised in some people's minds. Going forward, it is easier to make sure that we do not allow these conflicts to arise. But I do believe that with regard to auction rate securities, there was a danger several months ago that investor protection was falling between the cracks, not out of any malign decision to do it, but because other things were crowding it out, and because of some potential conflict in people's minds. I think through the efforts of a lot of people, and I think this committee was a part of it by frankly announcing the hearings and our staffs working together to talk to people, that we've helped elevate investor protection to where it should be. There are a couple of issues about it, but with regard to investor protection, one thing in particular is stands out in my mind that's changed some of what opinion had been, and that is we had previously taken the view, for instance, with regard to hedge funds, that we had to protect the unsophisticated investor, but that sophisticated investors, the principle of caveat emptor, could prevail. We had $1 million cutoff for hedge funds. But the people who have been victimized in this include some very sophisticated investors, individual and institutional. And I think what it shows is we are in a world today where the complexity and opacity of financial instruments is such that you cannot say, oh, well, if you got more than $1 million, you're on your own. I think we have to, this makes it clear that it's not enough to simply say, okay, we'll just let everybody do what they want and we just won't let you into it. We need to have the kind of regulatory system that, among other things, provides some safeguards, because, as I said, some of the most sophisticated entities and investors have been involved in this, and that means we have to broaden it. So I appreciate the participation of the witnesses. Our hearing is in part to figure out what's gone wrong. It's even more, it was in part to encourage compensation. And I think we've made a lot of progress there, and we will hear about that. I mean, we had 3 points. What went wrong? How can we sort of compensate or urge that people be compensated? And finally, and most importantly from this committee, what do we want to do going forward? Because we will be adopting a regulatory set of regulatory rules going forward. What do we do to diminish the likelihood of this happening again? Now, that being the statement, I do want to make one other announcement not related to this hearing, and it has to do with what the roles of the committee will be going forward. There's clearly a lot of interest in what's been going on with regard to the interventions that have come from the executive branch, in the case of Fannie Mae and Freddie Mac, authorized by us, in the cases of Bear Stearns and AIG, done by the executive branch or by the Federal Reserve. And I've had some requests about what are we going to do to look into it. This committee has a busy agenda. There is an overlap. I have had a meeting with the Chairman Waxman of the Government Reform Committee, and essentially we've got a kind of division of labor. That committee will be holding hearings under its jurisdiction, which is equal to ours, as our friend from Connecticut, a very senior member of that committee, knows. And it's always important to work out, I think, without friction, the authorizing committee and the oversight section. And what we have agreed to is that this committee will continue to function on the policy issues, and particularly on what going forward we ought to do to put in place to make these things less likely. The oversight committee, under its oversight function, will be looking into what happened, what didn't happen, what should have happened. They will be looking at the actions of the private sector and the actions of the regulators. Obviously, those are not exclusively and watertight compartments, but that's where we are. So there will be the thrust of the hearings into what happened and whether they were right or wrong are going to be going on the Oversight Committee. We will be talking about what's going forward. There is continuous contact, we hope will go on between the staffs, from both parties and both sets of committees. And I knew there was some interest in that. That's where we are. With that, I will now call on the ranking member to make his opening statement.
Thank you, Mr. Chairman, for holding this hearing. And before I address auction rate securities, let me just say to Director Thompson, I appreciate the action of the SEC yesterday. I think legitimate short selling plays an important role in our capital markets, but what we've seen in the last year is not abusive and naked selling. I think has weakened a lot of our financial institutions that probably would have survived had it not been for those abusive practices, because as short sellers, and often acting in concert with each other, systematically singled out one institution and drove down their stock, it undermined the confidence of the public and the customers of those institutions in the institutions. It impaired their ability to raise capital or to finance their debt. And I think in many cases, institutions fail. And although it was not the root cause of what we are facing today is years of over-leveraging, risk-taking, overextension of credit, failure of our rating agencies to properly regulate, and in many cases, because of our outdated financial system and inability in certain cases to regulate, or a patchwork of regulation where really no one was overseeing, for instance, the investment banks. But I will say that I believe with the action yesterday, and the first action was taken, it was limited to 17, I think, financial companies. I expressed at that time my concern that the short sellers, when that happened, they went to some of the smaller and more mid-sized banks and began concentrating on some of your smaller institutions. And I think that what was needed then and what you've done yesterday was a blanket order. And I've compared these packs of short sellers to jackals, which have actually attacked financial institutions and brought them to their knees. And I think it's definitely worsened what we're going through today. We all knew, Secretary Paulson and I in a conversation a year ago, he told me that it was going to be almost impossible to avoid a painful deleveraging because the chickens were coming home for roost. Many because of failure to regulate, many because the Congress didn't address problems which we have known existed, and that's across all administrations, and failure to modernize our system. But for whatever reason, and the industry in many cases resisted attempts to regulate them. They resisted it very harshly. I was attacked across the board by the financial services industry when I proposed a subprime bill 3 years ago. And they went out, they told the public, they told my colleagues that there was absolutely no problem in subprime lending, and trying to regulate and impose some standards was going to make things worse. And a year and a half ago, both Mr. Chairman Frank and I referred to what we considered some dire straits that we were in, and we were both criticized by our colleagues as being as exaggerating the situation that we were in.
More of your colleagues than mine.
What?
I think it came more from your colleagues than mine.
There were quite a few. And another thing that the Congress didn't do at that time, there were things, for instance, that the chairman and I agreed on, excuse me, but some of the colleagues wanted more, some wanted less, and they would not agree to compromise. And we could not get anything done. And often that's the situation. You always have folks that, that say they want to go further, people that say they don't want to do anything at all, and what fails to happen is anything. And that certainly happened. And I think had it been left to he and I, we would have had a subprime lending bill 3 years ago. It wouldn't have been all that people asked. I'm going to submit my remarks on auction rate securities as a matter of for the record. Let me simply say, with the auction rate securities, many of them were sold as being very liquid to investors, cities, counties. They could get in, they could get out. It was a wonderful way to finance debt, and it would always be liquid. And suddenly in February, March, they found that these assets were not, they were totally illiquid. It was almost like a roach motel, a financial roach motel. They could get in, but they couldn't get out. It was a nightmare for our cities and counties. It caused tremendous in our states. And I am glad because of some of the efforts of people in our first panel and others, and our announcement with Mr. Kanjorski that we were holding a hearing and investigation, that a lot of that appears to be resolving itself. But as we deal with the stability of our financial markets, a large component of that is going to be the auction rate security market. And I do believe that's one area that we're making real progress, and it is beginning to resolve itself, and I think that will have positive implications for the economy. Thank you, Mr. Chairman.
Thank you. Before we get to the Orkin men and women in the panel, is there any other opening statements? I think the gentleman from New York.
First of all, I want to thank the chairman for his leadership, not only on this issue today, but this has really been the most troubling time that I have ever seen on this committee. And I would say that the markets have not seen such turmoil in our country, and I would say worldwide, since the Great Depression. And I strongly believe that we should be looking at a RTC-like mechanism to take care of this crisis now. We cannot continue to approach it in a piecemeal way. We need a comprehensive approach. I would like to be associated with my colleague, the ranking member, and the chairman of the committee, particularly on the naked shorts. Many people have called me and they believe that their company would be there, their jobs would be there if this abusive practice had been stopped earlier. So I applaud the SEC's action, and I feel that we should have a hearing and look in more to these naked shorts. With regards to the auction rate securities market, we all have been following the situation since the market for these securities froze back in February. At its height, $160 billion worth of auction rate securities were issued by state and local governments, charities, colleges, and universities of all credit qualities and sizes. But in February, everything just stopped. Since this time, everyone has been asking how these securities, which were being marketed as something safe and as liquid as cash, could have frozen all at once, leaving $64 billion worth of securities locked up. I have had constituents who've come to me. They said they took out these securities. They said they could get their hands on it. It was as good as cash. They still cannot get their money back. Over the summer, we have seen settlements with the New York State and Massachusetts State Attorney Generals, which will require banks to pay fines and buy back much of the $64 billion in frozen securities. While I applaud this effort, I still have concerns about the costs that the states, municipalities, and other public entities who were the issuer of these auction rate securities have been forced to incur. And their liability, of course, then becomes a taxpayer liability. In a recent speech by former SEC Chairman Arthur Levitt, he made the following point about these issues, and I request unanimous consent to put his entire, and he stated that, he really points to the need of more transparency, and I quote from him, "As we try to unravel what happened, what becomes clear is that too many issuers were left in the dark. Many had no independent advisors, and those that did not hire advisors often found themselves receiving advice from parties that were conflicted, since these advisors also worked as a banker in the auction securities market." He also reminds us that problems in this market have been known about for at least 4 years as a result of an SEC investigation into the broader market in 2004 and 2008. And that a lawsuit by the Massachusetts Secretary of State revealed that going back to 2006, nearly 85% of the auction would have failed or produced different results without the single broker's intervention. At this hearing, I'm particularly interested in learning exactly what happened and why it happened, and in learning why exactly this market froze simultaneously in February, despite this market having problems and not functioning properly for many years. And why were these large penalty rates required for most issuers, but not required of the closed-end fund issuers or most structured bond issuers, though the securities were sold by the same underwriters to the same investors? So these are some of the questions that I hope to hear answers today. Again, I thank the chairman for having the hearing.
The gentleman from Texas is recognized for 3 minutes.
I thank the chairman, and I would ask that I could just revise and extend my remarks, and I'll summarize.
All members will have general leave to put anything on the record they want.
Yeah. Well, I thank the chairman for having this hearing today because auction rate securities have played an important part of our market, and particularly I want to address my remarks primarily to the student loan program because what has happened over the last year is, one, we passed legislation here where we reduced the amount of federal subsidy to help some of these student loan securities be securitized and financed. And at the same time, one of the major financing vehicles for student loans was affected by the fact that with auction rate securities. And so I think what we're seeing, and I think I applaud the chairman, is I think this committee does need to focus on those things that we can do to get the markets back acting in a normal way again, because the sooner we can do that, the better for all of the players. Unfortunately, some of the actions by some of the players that were not good actions, poor decisions were made, has affected the entire marketplace. And our auction rate securities have played an important part for cities, and particularly for entities that are financing student loans. We've been hearing from our bank friends all during the spring and summer their concerns about, because some of their traditional sources to be able to go with their student loans had basically dried up because many of these entities, one of those in my district, has quit making student loans or quit purchasing student loans from banks until they can work through this, because quite honestly right now, with the cost of financing or providing other financing vehicles for some of these loans just doesn't make economic sense for them. So I think as we would hear from the panel today, I think one of the things that we need to hear is ways that you think. I'm not a big market interventionist from the federal government. Maybe the best thing for us is to get out of the way and let the markets start functioning again. But certainly the sooner that they function, start functioning more appropriately. I think obviously the better for students and cities and other entities that have used these securities to, because, one of the issues was a lot of these entities, it wasn't the credit worthiness necessarily of those issues. It's just that once that pendulum started swinging, there was a confidence factor that spread throughout the market, basically froze all of those auctions, and so raising the cost of financing for many of those entities, obviously providing some liquidity issues for people that thought that you could just get your money out of those at any time. And I think one of the underlying questions is as you look into your crystal ball here, do you see auction rate securities back in the marketplace again? And with that, I yield back the time.
Thank the gentleman from Georgia. Recognized
Thank
for
you.
3 minutes.
Thank you very much, Mr. Chairman. I'll be very brief. I hear a lot of discussion on the other side about getting out of the way and letting the markets take care of themselves. If anything we've learned, that is absolutely the wrong thing for us to do. If anything, we need to get in the way. And we need to get in the way very quickly, because this is not just a problem in the United States anymore. This is a worldwide problem. And our prestige as a financial leader of the free world is at stake. The two underlying issues that we need to address very quickly is the declining value of the dollar at home and abroad especially. But the other fact of the matter is, where do you think we're getting this money? Where do you think we're going to get the money to bail out AIG, Bear Stearns, Fannie and Freddie? It's not just being pulled off a tree. We're borrowing this money. Our debt is going out of the ceiling. And where we're borrowing it from? Foreign nations and foreign governments at a rate that is really crippling the future of our financial stability in the world. So, Mr. Chairman, I just wanted to add my 2 cents to that, because this is a very urgent issue. And we need to get in the way very quickly, and we need to find the appropriate vehicle to intervene, much like the RTC that the chairman has talked about as we responded to the savings and loans crisis of 1984, I believe. So this is a very serious issue. The one before us with the auction rate securities is especially, and I want us to deal with more detail as we get into this discussion today about the risk that is involved with the ARS market. We need to understand that. We need to know not only what is being done, but what can be done in the near future to address this collapse. Could more have been done to assess, to anticipate, and further have prevented the auction rate mess? Were investment firms and broker-dealers well aware that the ARS market bubble was about to burst? There's a lot of culpability here. The nature of the recent settlements, the role of the auction manager. There's a lot we have to get in with this, but this is part of this bigger picture, and I think the climate in Washington needs to get very serious and get in the way and save our economy and the prestige of the United States as being the financial leader of the free world. Thank you, Mr. Chairman.
Gentleman from Connecticut is recognized for 3 minutes.
Thank you, Mr. Chairman. I first want to say that I think you are recognized by almost all the members here as being one of the smartest and the most effective. But I think the one area that you aren't recognized, and I want to pay particular salute to it, is that you have taken this issue, as you do so many others, instead of trying to make it a political issue, have tried to say, we've got a huge issue, how do we come together? You have done a remarkable job, I think, of trying to get this committee to understand these problems and work together for the good of the country. And I just want to first thank you for that. Secondly, I want to say that the smaller federal family education loan providers, the PELP providers, have utilized the auction rate securities market to raise capital to originate new loans. And so when this market froze, certain FELP providers were unable to obviously access capital. In July 9th, I wrote you and our ranking member, Mr. Baucus, who I also appreciate the team that you have become, and saying, let's have a hearing on this. So First, I want to thank you for doing this, having this hearing. There's a lot about this process that I need to understand better. But what I do understand is that, you know, we've seen 19 of the top 100 lenders leave the federal family education loan program entirely. And these totals include 14 nonprofit state loan agencies, 3 state loan agencies, Pennsylvania Higher Education Assistance, the Massachusetts Education Finance Authority, and the Michigan Higher Education Student Loan Authority. I'm told have suspended all FFEL originations. So every type of lender has been affected: 14 state loan agencies, 56 banks, 14 credit unions, 4 nonprofit lenders, 3 school-as-lender schools, with 45 coming soon, and 34 non-loan banks. This is a very serious problem. One of our strengths as a country is that we have the best educated, best trained workforce. Our strength has still been, particularly in higher education. And I remember when the government was almost shut down with the Clinton administration and a Republican majority in Congress. And I think I heard more from parents concerned their kids were not going to get their student loans and the programs would start to shut down. It was interesting, the number that were focused just on that issue. If we don't resolve this issue, we are going to hear from a lot of people, and rightfully so. Yield back.
I thank them, and I thank him for his very gracious words. And it's obviously been with the cooperation of most of the members of the committee that we've been able to do this. I would now put into the record, under the general leave, a very thoughtful essay from Professor Frank Parker, who is a professor of real estate development at the Carroll School of Management, which is in the congressional district I represent at Boston College, in the state legislative district the Secretary of the Commonwealth used to represent and lives near. But it's a very thoughtful article. And then also a written statement from the North American Securities Administrators Association. And let me just say, as we begin the testimony, we've had debates here from time to time over whether or not there should be a preemption at the federal level of the role that the states play in securities law. And anyone who wanted some evidence that it would be a mistake to wipe out the state role or even substantially diminish it can look at the history of this issue, because it has been at the state level that we have seen, from my own state of Massachusetts, from New York and elsewhere, a degree of intervention. I believe the state of Missouri, our colleague's sister in the state of Missouri, Ms. Cunningham, that in a number of states it has been the state securities officials and law enforcement officials who've taken the lead. So I am pleased to put their statement in the record, and they are entitled to say this is a strong affirmation of the need for their role. And we will now begin with our panel, and we'll first hear from Linda Thompson, who's the head of the Division of Enforcement of the U.S. Securities and Exchange Commission. Ms. Thompson.
Good morning. Chairman Frank, Ranking Member Baucus, and members of the committee. I'm Linda Thompson, the Director of the Division of Enforcement at the Securities and Exchange Commission. Thank you for the opportunity to testify today about the Commission's efforts in response to the freezing of the auction rate securities market in mid-February 2008. I've submitted my written testimony and asked that it be made part of the record. I'd like to start with the very big picture, and that's this. Thanks to the collective efforts of federal, state, and SRO law enforcement and securities regulators, thousands and thousands of investors have billions and billions of dollars of liquidity restored to them in very short order. This relief is virtually unprecedented in type, magnitude, and timing. And due to these collective efforts, investors in auction rate securities at a number of firms, including retail customers, small businesses, and charitable organizations, will have the opportunity to receive quickly 100% of their dollar investments. Customers who accept these offers will receive all of the interest payments or dividends they are due, and will be given the opportunity to sell their auction rate securities without a loss. Since the auction rate securities market seized up in mid-February of 2008, the need to restore liquidity for investors has been of paramount importance to the SEC and to our fellow regulators. through the Division of Enforcement Settlements in Principal with UBS, Citigroup, Wachovia, and Merrill Lynch, over $40 billion in liquidity will be made available to tens of thousands of customers. Auction rate securities were first developed in 1984, and as of 2008, it was estimated that the market had grown to $330 billion. Until mid-February in 2008, auction failures were extremely rare, and the market was highly liquid. For a variety of reasons, including the subprime mortgage and credit crisis that was unfolding throughout the second half of 2007, the auction rate securities market seized up in mid-February 2008, and the securities became illiquid. The SEC's staff reacted immediately. The Division of Enforcement began investigating and deployed tremendous resources to the effort. In March of 2008, enforcement staff began collecting detailed information from 26 broker-dealer firms. We interviewed investors and other market participants, including employees of broker-dealers and issuers. We established a dedicated email box to receive investor complaints. Since mid-February, the Commission has received over 1,000 complaints concerning approximately 50 broker-dealer firms. Investors reported that their brokers had led them to believe that they were investing in safe and liquid investments, cash equivalents, and when the market froze, that they could not access their funds for important short-term needs, such as a down payment on a house, medical expenses, college tuition, taxes, and for some small businesses, payroll. To conduct investigations quickly and avoid unnecessary duplication, we also coordinated our efforts with other regulators, including FINRA, the Office of the New York Attorney General, and the North American Securities Administrators Association and its membership, including, of course, the Office of Secretary Galvin. The two largest auction rate securities market participants were Citigroup and UBS. These firms became the primary focus of the investigations being conducted by the SEC's enforcement staff and our fellow regulators. We were acutely aware that time was of the essence, and we expedited our efforts accordingly. In early summer, enforcement staff, along with our colleagues from the New York Attorney General's office, embarked on an aggressive schedule of taking testimony from employees of Citigroup and UBS. Our investigative record indicates that both firms made misrepresentations and omissions to their customers when marketing and selling auction rate securities. The SEC's investigation further shows that until the auction rate securities market seized, Citigroup and UBS marketed auction rate securities as safe and highly liquid investments with characteristics similar to money market accounts. These firms misleadingly characterized auction rate securities as cash alternatives or money market and auction instruments. The firms failed to disclose that in late 2007 and early 2008, auction rate securities liquidity risks had materially increased as the firms knew that there was an increased likelihood that they and other broker-dealers would no longer support the auctions. Early on, the SEC's staff, in coordination with the New York Attorney General's office, took the lead in structuring, proposing, and negotiating the framework for a settlement that included liquidity solutions. This framework was developed in consultation with the SEC's Division of Trading and Markets and other federal regulators in light of the potential impact on the broader capital markets. Of paramount importance was providing quick liquidity solutions for retail customers, charities, and small businesses that were, from our perspective, most in need of access to their funds. The agreements in principle with UBS and Citigroup established a general framework for other firms' settlements. Other state regulators, especially through NASA under the leadership of its president, Karen Tyler, and its auction rate securities task force, which included Secretary Galvin and who provided tremendous leadership in this effort, quickly joined the efforts, and I should note that I believe it was Secretary Galvin who filed the first suit with respect to auction rate securities. Although negotiating global settlements was not easy, the state and federal regulators proceeded in good faith, working virtually around the clock for weeks. All of us felt that working together enabled us to maximize the relief provided to investors. In early August, the SEC, the New York Attorney General's Office, NASA, The Massachusetts and Texas Securities Authorities announced settlements in principle with Citigroup and UBS. In pertinent part, both firms agreed to offer to purchase frozen auction rate securities from retail customers, small businesses, and charitable organizations at 100 cents on the dollar. Both firms also made whole any losses sustained by customers who sold their auction rate securities at less than par after the market had frozen, and both will offer no-cost loan programs to eligible customers with immediate liquidity needs. The settlements also provide a mechanism through FINRA for customers to participate in a special arbitration process to pursue consequential damages. As for larger institutional investors, UBS has agreed to offer to purchase auction rate securities at par over a longer time frame, while Citigroup has agreed to use its best efforts to provide liquidity solutions for its institutional customers. The proposed settlements contemplate that the Commission will defer imposing financial penalties on the settling firms in order to evaluate, among other things, their performance under the settlements. The SEC staff is now finalizing the settlement terms with the firms, which it will then recommend to the Commission for approval. In addition to the first settlements with UBS and Citigroup, the SEC staff and others have reached settlements in principle with Wachovia and Merrill Lynch, and our efforts are continuing. I'd like to thank you for this opportunity to discuss the Commission's efforts with respect to the auction rate securities markets, and I would be happy to answer any questions. Thank you very much.
Thank you for your testimony, and we will now hear from Susan Merrill, who's the Executive Vice President, Chief Enforcement at the FINRA.
Chairman Frank, Ranking Member Baucus, members of the committee, I'm Susan Merrill, Chief of Enforcement at the Financial Industry Regulatory Authority, FINRA. On behalf of FINRA, I thank you for the opportunity to come and testify here today on these important issues. FINRA is the largest non-governmental regulator of the securities business in the United States. All told, FINRA oversees 5,000 brokerage firms and over 600,000 registered securities representatives. We at FINRA have been actively involved in working to resolve the issues relating to auction rate securities. From our exam staff to our enforcement team, from our arbitration forum to our investor education group, we've devoted staff from all parts of our organization to provide a comprehensive and integrated response to the recent challenges in the auction rate securities markets. Along with our regulatory counterparts, FINRA is committed to continue working on these important issues. We share this committee's interest in holding industry participants accountable and providing investors with real and tangible relief. Today, FINRA is announcing agreements in principle with 5 firms for violations regarding the manner in which these firms sold auction rate securities. The violations include using advertising and marketing materials that were not fair and reasonable and did not provide a sound basis for evaluating the facts regarding the purchase of auction rate securities. They also include supervisory violations relating to the firm's failures to achieve compliance with FINRA rules surrounding the sale of these products. Most importantly, in settling these cases, FINRA focused on restoring funds to customers. All of the firms involved in the settlements today have agreed to offer buybacks of auction rate securities sold to their individual and small institutional investors. This will mean that over $1 billion of auction rate securities will become liquid again. We at FINRA think this is the right result. By expanding our scope beyond those firms that the SEC has rightly focused on, we've protected additional investors and restored funds to a broader span of customers. As for those firms who have not chosen to resolve their regulatory investigations and offer buybacks of their securities, their customer securities, we'll continue to investigate these firms aggressively with a view to bringing enforcement actions where appropriate. The cases we announce today are the result of the work that FINRA has been doing since the market for these securities froze up and we began to receive complaints in February. FINRA immediately questioned more than 200 firms regarding their holdings in auction rate securities, both proprietary and customer accounts. We then used that information that we gathered in that survey to inform our next steps. After consulting with the SEC in order to avoid duplication of efforts, we sent out sweep letters in April to 24 firms. This summer, we sent out a second sweep letter to more than a dozen additional firms. 53 FINRA staff members conducted on-site examinations of over 32 firms in more than a dozen states. On-site examinations are continuing as we sit here today. All told, FINRA enforcement is investigating over 40 firms in connection with their marketing of auction rate securities. FINRA has also been active in issuing regulatory notices regarding auction rate securities. These notices provide guidance to firms on critical customer protection issues, including requiring firms to put customers' interests ahead of their own when allocating partial redemptions, and clarifying rules that allowed investors to sell auction rate securities at a discount if they wished to do so. In addition to our regulatory examination and enforcement initiatives, we at FINRA feel strongly that effective investor protection begins with education. That's why in March we published a comprehensive investor alert explaining in plain English what happens when auctions fail and what options are available to investors. In August, FINRA announced the establishment of special arbitration procedures for auction rate securities cases administered in our arbitration forum. Under these procedures, individuals who have worked for a firm that sold auction rate securities since January 2005 will not be eligible to serve as arbitrators. There are also special procedures for arbitrations filed pursuant to the regulatory settlements with the SEC and with FINRA. But it's important to note that the procedures I just outlined will be available to all auction rate securities investors, whether or not their firm has settled with a regulatory agency. In conclusion, FINRA has employed a comprehensive and integrated response to the recent challenges in the auction rate securities markets. FINRA will continue to aggressively pursue possible violations by firms and will continue to work with this committee and our regulatory counterparts to advance our essential investor protection mission. I thank you again for the opportunity to testify here today, and I'd be happy to answer any of your questions.
Thank you. And next, a securities administrator, the Secretary of the Commonwealth of Massachusetts, where we have the securities in his jurisdiction, who's been a real leader in efforts to provide protection here, and is incidentally, a former legislative colleague of myself, Mr. Markey, Mr. Delahunt, and Mr. Alver. So we welcome him here, Mr. Galvin.
Left out Mr. Lynch. You left out Mr. Lynch.
Were you gone by the time he got there?
No.
Oh, you hang on longer than I thought. All right. All right.
Good morning. I'm William Galvin, Secretary of State and Chief Securities Regulator of the Commonwealth of Massachusetts. I want to commend Representatives Frank and Baucus for calling today's hearing to examine the causes of the failure of the market for auction rate securities and potential ways of making our regulation of the financial securities industry more effective. While I'm here today to discuss our findings and investigations into UBS and Merrill Lynch sales of auction rate securities, I feel compelled to say at the outset that there is a much larger issue here, and that is this. The auction rate security scandal is just one more variation on a reoccurring theme that we have seen before. And that theme is the documented belief of large segments of the financial services industry that they are above the law, entitled to special privileges, entitled to engage in conflicts of interest, and owe no duty or obligation to average investors. I'm here to speak of the lessons learned from our investigations and to present proposals for preventing such problems. but I must say that without stricter regulation and sustained and diligent enforcement, this theme will again emerge. Specifically, 5 basic facts, I believe, arise from the auction rate debacle. They are that conflicts of interest need to be more aggressively monitored and disclosed to investors, that financial advisor incentives need to be disclosed, and financial advisor training needs to be enhanced, that supposedly objective research reports need to be more tightly regulated, and that self-regulation is not effective to prevent a scandal such as this one, and that the state regulators, in conjunction with their federal counterparts, need to continue to be actively involved in enforcement actions. I believe that the need to ask ourselves difficult questions about how we can make our regulatory scheme more effective is especially important given this week's market events. Government intervention is more effective when it monitors aggregate risk-taking and prevents bubbles from building instead of having to bail out the parties after the bubble has burst. In June of this year, my office filed an administrative complaint against UBS in conjunction with its marketing and sales of auction-rate securities. The details of the allegations have been provided in my written testimony. Briefly, our investigation exposed a profound conflict of interest between UBS and its customers and the devastating effect that this conflict had on those customers. It exposed how UBS was, unbeknownst to its customers, propping up its auction rate market and manipulating the interest rate at which the auctions cleared. It also exposed as how the auction rate markets became more risky. As they became more risky, UBS increased its efforts to unload auction rate risk from its own balance sheets onto the accounts of its customers. In July of this year, my office filed an administrative complaint against Merrill Lynch. The complaint charged that the firm was implementing a sales and marketing scheme which significantly misstated the nature of auction rate securities and the overall stability of the auction market. The complaint also focused on the extent to which Merrill Lynch co-opted its supposedly independent research department to assist in sales efforts geared towards reducing its inventory of auction rate securities. Our goal has been that all investors stuck in auction rate securities will be made whole. My office, as well as other regulators, have entered into settlements with UBS, Merrill Lynch, Bank of America, and other underwriters and sellers of auction rate securities. In those settlements, the firms have agreed to repurchase tens of billions of dollars worth of these securities. Much work remains to be done. However, it's not too early to step back and attempt to draw lessons from this experience that might help us prevent such breakdowns from occurring in the future. The UBS and Merrill Lynch cases highlight the conflicts of interest that can arise between a broker-dealer and its customers. It became apparent that the broker was controlling the interest rates at which most of the auctions cleared. In doing so, the broker was beholden to its investment banking clients, to whom it had promised low-cost financing, yet needed to raise interest rates just enough to be able to unload its own inventory onto unsuspecting clients. Prior to the market collapsing, when each firm made a big push to reduce its own holdings of auction rate securities, it did so by foisting those securities off on unsuspecting clients. These conflicts need to be aggressively monitored to determine whether they fundamentally impair a firm's ability to responsibly attend to its clients' needs. At a bare minimum, these conflicts need to be properly disclosed. Two other points which arose starkly in our investigations were the significant incentives to financial advisors to move auction rate products and the profound lack of training of those advisors receive with respect to those products and their attendant risks. Most investors assume that their financial advisors are selecting financial products for them is indeed applying his or her professional expertise with the primary goal of choosing financial products that are most appropriate for that customer's particular circumstances. However, our investigations reveal that UBS and Merrill Financial Advisors receive substantial incentives, unbeknownst to customers, to sell auction rate securities. I believe that regulators should require more comprehensive disclosure of the financial incentives that financial advisors receive. This would allow the consumer to better assess whether the advisor is selecting the product based on customer suitability, or maximizing commission revenue. Another proposal that merits serious consideration is explicitly holding broker-dealer agents to a fiduciary standard of care with respect to their customers. Such a step is especially important given the increased complexity of financial products and the increased dependence of customers on the advice of their financial advisors. The next point I would like to discuss is research reports. 5 years ago, a number of securities firms, including Merrill Lynch, reached a settlement with regulators that was supposed to eradicate the conflicts of interest that pervaded Wall Street research and analysis. However, that settlement technically applied to only stock research and not to fixed income research. Merrill was quick to make this distinction in its statement following my division's filing of its complaint. However, the principles underlying the settlement, that research reports presented to the public as being supposedly independent should not be tainted by undisclosed conflict of interest, have not been adhered to in this instance. As a result, more rigorous rules pertaining to research reports are necessary. I believe the overnight disappearance of the $330 billion market for auction rate securities should give pause to those who think that markets can effectively police themselves. If the free market is to be truly free and survive, it must be saved from its own greed and its repeated willingness to deceive and dissemble in the name of higher profits. The conflicts of interest raised here stand in stark contrast to the idea that market participants, guided by principles such as FINRA Rule 2110, which imposes high standards of commercial honor, will simply follow those principles and do not need more detailed regulation. It's difficult to imagine that offloading a known and worrisome risk of auction rate failure off a firm's own balance sheet and onto its customers' holdings is consistent with high standards of commercial honor. I believe that a move in the direction of principle-based regulation at the expense of detailed enforceable rules would simply open the door for more misconduct. The point is especially important given this week's market events.
We're going to have to wrap this up soon.
I would conclude, Mr. Chairman, by saying that I think we are clearly at the point in time where the entire market regulatory scheme is going to have to be reviewed. And I would urge this Congress and the next administration to do so with a view towards rewriting the entire system. I think this episode that we are here today discussing demonstrates the failure of that system. And I would hope that when it is rewritten, it is written in such a way as to protect investors first. That should be the first goal of any financial regulatory system. I'll be happy to answer additional questions.
Thank you. Next, another state official who's been very active in this consumer protection field, Attorney General of Massachusetts, Martha Coakley. General.
Thank you, Chairman Frank and Ranking Member Backus and the committee. I, like Secretary of State Galvin, are pleased to be here today. I appreciate the invitation. I am the Attorney General for Massachusetts, and our office shares some responsibility with the Secretary of State for public enforcement of securities laws at the state level in Massachusetts. Our office, as in most states, is authorized to bring criminal and civil actions in our state courts against investment banks, brokers, and issuers who deceive investors or fail to meet required legal standards. Our office also has exclusive authority to bring actions under our State False Claims Act against entities that mislead towns, cities, and other state entities regarding investment decisions. Auction rate securities sold in Massachusetts have been of great concern to us, and although these securities have long-term maturities for many years, they historically have been offered for sale at weekly or monthly auctions, which provided, and I stress, the appearance of periodic liquidity. My colleagues on this panel have discussed that. That's one of the major issues for us in looking at these, was the appearance of liquidity. Because of this supposed liquidity, auction rate securities were touted as being cash alternatives, and when earlier this year the market for auction rate securities dried up, the auctions through which they were sold experienced widespread failures, eliminating liquidity and making it difficult to dispose of the securities at all, much of which has been evidenced by my colleagues here today. When the securities were written down to reflect the reduced market value, many investors suffered serious losses in their investment principal. In early 2008, Secretary of State William Galvin talked with our office, and he requested that our offices divide responsibility, and frankly, our Attorney General's office concentrated just on the sales to towns, cities, and state entities, and focused on whether state entities as customers were misled regarding the appropriateness of auction rate securities as investment. We served investigated subpoenas. We met with affected municipalities. We reviewed documents, and we took testimony from investment banks and their agents. We carefully scrutinized broker behavior, disclosures, as well as the lack of disclosure, as we've done in the predatory lending market, and the behavior of investment banks as they sought to transfer auction rate securities from their own accounts to those of their customers. 6 weeks after starting our review of the investments of Springfield, Massachusetts, and days before the broader market for auction rate securities began to melt down, we recovered from Merrill Lynch at par the $14 million that Springfield had invested in auction rate securities. We initiated our review of UBS on the same day that UBS began letting its auctions fail, and we completed that investigation in 10 weeks. There we recovered over $37 million for 18 Massachusetts municipalities and state entities. We began our review of Morgan Stanley in the same time frame, which resulted in the recovery of an additional $2 million for cities and towns. And finally, last Friday, our ongoing review of Citibank resulted in Citi's agreement to return $20 million to the Massachusetts Water Pollution Abatement Trust. Our recovery against Merrill was the first recovery by a state in the auction rate arena, and our consent judgment against UBS was the first court-ordered resolution by a public enforcer. We believe that our early investigations and litigation efforts helped jumpstart the broader resolution process, and we commend the terrific work of Secretary Galvin, the SEC, and FINRA, and other regulators in other states for the roles they've played in moving the larger process forward. Let me make 3 quick recommendations. First, any solutions reached should actually return full investment amounts to all investors. We talked today about agreements to repay. I think it's really important that payments in fact be made. Secondly, that those be made extremely promptly. And third, that nonprofit and governmental issuers should not be forced to incur additional expenses and losses as a result of this. In addition, the committee should not overlook the problems with the underlying assets backing some of these securities, and we have submitted testimony for yesterday's hearings relating to our work around the predatory lending in the subprime market and how that has affected Massachusetts and how we, frankly, have not seen any restructuring of transactions to be successful. I think that as we've stressed, the restitution and having it quickly is important, and our emphasis, obviously, in state government is for our government entities and our nonprofit entities mentioned by members of the committee earlier, particularly around the student loans. Finally, even if the committee is able to resolve the immediate auction rate problem, as Secretary Galvin has noted, we still need to consider the stability of the underlying assets that back these notes. We should be careful to ensure that intermittent liquidity crises in financial markets do not disproportionately harm consumers. We appreciate the chance to talk to you today, are happy to answer questions, and more importantly, are happy to work with you as you look at further solutions and other legislation. Thank you.
Thank you. Let me begin. Ms. Merrill, you mentioned that there were 5 settlements recently reached. I am struck by the coincidence of those individuals, those entities being willing to sign those agreements on this, right around this time. Could you tell us who they are? I assume it would be appropriate to mention who they are.
Absolutely. The names of the 5 firms that have settled with us today, the agreements in principle were reached last night, and we're announcing them this morning. They are SunTrust Robinson Humphrey, SunTrust Investment Services, Comerica Securities Incorporated, First Southwest Company, and WAMU Investments, Inc.
Thank you. Now, a couple questions. You mentioned, this is one that gets us to another topic, but Secretary Galvin, at an earlier point, was one of those who called to my attention problems with the arbitration procedures and a view, and we had a hearing on this, that the individual one-time investor or investor engaged in a one-time arbitration is at something of an institutional disadvantage. I was pleased, therefore, that you mentioned some special rules, but my question would be, if those are good rules for this, why keep them special? Why not make those rules for arbitration in general in these situations?
That's a good question. We had a rule that covers exactly how our panels are constructed for arbitration. It would require a rule filing, which would take a good bit of time to get through the approval process. And so we wanted to quickly do it for this, and we were able to
But your
just
intention
change
would
the
be to carry
application.
that out for other things as well?
What we're doing in terms of our broader arbitration forum is right now we've announced a pilot program with 10 firms, and those firms represent the vast majority of all arbitrations that are filed in our forum. Those big firms have agreed to use a pilot program for 2 years where there will not be an industry representative at all on the panel. In other words, the panel will be purely public. Once we see the results of that pilot program, we will certainly look at expanding our rule to make that across the board. But we're very pleased that the firms have stepped up and agreed to the pilot
All right, well,
program.
we'll get back to that. I don't want to, but I raise it, but that is important. Let me go back, though, to a point that Secretary Galvin raised, and that is the principles versus the rules. And I understand the desire of many in our country to say, well, we like a little more flexibility, but here's the dilemma that we confront. In a number of cases, when people raise objections to certain behaviors, the defense is, well, it wasn't prohibited. That is, people in the industry should understand, if they are going to use the absence of a specific in hoc verba prohibition as a permission to do something, then the case for more flexibility is undercut. And I say that because people say, well, we want principles and not rules. I don't know the exact rules that were involved here, and in some cases it would seem to me there were rules probably broken, but I can't imagine that in principle people didn't understand this was the wrong thing to do, given what's been described. So I'd ask the Secretary for this. I mean, is this an example, frankly, of people taking advantage of an absence of specificity and a case where principles that we would have assumed were pretty generally subscribed to didn't serve as an adequate defense?
Well, clearly, I think that's the case if that were all we had to rely on. And in the cases that we brought in Massachusetts, we alleged that there was fraud on the part of the 2 cases that we actually brought, and we were still investigating some of the others. But I think the absence of detail rules, the absence of a requirement for financial advisors to be looking at the financial suitability of certain investments, those are clearly demonstrated by this situation. Many of the people that call my office, as you've heard from some of the other witnesses this morning, were specifically told that these were, quote, cash-like instruments. They were promised liquidity. They were led to believe, not only because of past practice, but because it was specifically said to them, that they would have no difficulty getting their money out. And that obviously was not accurate, and was particularly sinister when there were firms that knew these things were going down and specifically had made a decision at some point no longer to support them. And that's what we maintained in our complaints. I think it clearly requires more specific rules, and as I attempted to point out, I think it's a broader issue than just this particular type of
I
transaction.
appreciate that. Last question to Director Thompson. You know, we've had questions in the past. Am I correct in inferring that this seems to be a case where there was reasonably good cooperation between the federal regulator on the one hand and our state regulators, and this is an example of how we might be pooling resources to the common good?
I think this is an example of terrific cooperation on all our parts. And I should jump in right now to congratulate FINRA on the recent cases. But when you step back and think about this problem really arose in dramatic fashion in February of this year. And through the efforts of everyone here, state regulators, federal regulators, FINRA, we have reached a solution for retail investors in very short order that gets them 100% liquidity back. And we have worked together to get that. It's really an exceptional result, and does reflect all of us working together, I think, quite well.
Thank you. I have got to step out for a little bit, and Ms. Waters will preside. I will be returning.
Thank you very much, Mr. Baucus, our ranking member, for 5 minutes.
Thank you. Director Thompson, what is the status of the the Commission's examinations that were announced July the 13th to examine the controls against manipulation of security prices through the intentional spreading of false information?
Well, let me talk generally about where we stand with respect to the concern about spreading false rumors. As you pointed out in your opening statement, there is not, if people are engaged in spreading false rumors, driving stock prices down, that conduct is reprehensible. It's also illegal.
And pull the mic a little closer to you.
Oh, excuse me, I'm sorry.
There you go, that's fine.
And it is our, over the past several days, as you've noted, we have increased our efforts and our tools. We, as you may know, earlier this year, a few months ago, we brought our first case against someone for spreading a false rumor. It was a Berliner case. The Berliner case, it was brought shortly after Bear Stearns collapse. We have been investigating aggressively, and yes, as of 12:01 this morning, new rules went into place to put further controls on abuse of short selling, naked short selling. Late last night, we announced that the Commission is going to be requiring reporting of short positions by large investors, which will help in both transparency and in law enforcement. And as you know, as part of last night's announcement, I made clear that the Enforcement Division will be pursuing these issues with a vengeance.
How quickly will the SEC be able to determine whether or not, or be able to detect whether illegal trading or manipulation through illegal short selling is going on?
I'm not going to lie to you. These are difficult investigations. It's going to require lots of hard work, but we are deploying lots of resources to get there. We will follow the evidence as quickly as we can, and if there is evidence, we will bring those cases as quickly as we can. We want to make sure if we bring those cases, we have the evidence to sustain the action, because we think, as I say, I think the behavior, if it can be established, is reprehensible, and as I said, it's illegal.
Okay. Let me ask this question to both FINRA and the SEC, or Ms. Merrill. You know, the current broker licensing examination doesn't have a single question on auction rate securities. Is that an omission, and should questions be asked of financial professors, professionals, people that want to be in this regard?
Well, I think your question highlights an issue with auction rate securities that we're looking at internally at FINRA, and that is something that we look at on a risk-based basis. We saw these securities as relatively low risk. Certainly on an examination for a registered representative, you can't ask about every product that a rep can sell. And so this one may not have risen to the level. But now as we look back at this, we can see that there may not have been such default risk, but certainly there was liquidity risk. And since that's the way this product has really been marketed as liquid, that's what we really need to go back and examine.
Yeah, are y'all going back sort of and looking when you train those that are going to market financial products and license them, whether there are other areas other maybe than auction rate securities where they simply don't have the expertise to market certain things? They don't disclose things because they may not know?
Yeah, training is so important. Firms are responsible for training their registered representatives, of course, well beyond the licensing of the initial Series 7 test. And what we found when we went out and interviewed the brokers who were actually on the phones and talking with investors is that many of them themselves did not appreciate the liquidity risk. They didn't understand the auction. And that's a failure of the firms to train their reps.
Okay, thank you. I noticed with today's announcement that 16 firms that have made agreements. You've still got about 35. Now there's the smaller firms, but some of them, Main Street firms or regional firms. And are you making a lot of progress with the other 35?
Yes, most of the firms, in fact, that we are looking at are the smaller downstream firms. The issues there are different from the cases that have been brought by Secretary Galvin and by the SEC and other members of NASA, insofar as these are really not fraud cases, but we do believe that every broker-dealer has the responsibility to be marketing the product fairly. And they may say that they didn't know that there were cracks in the auction rate system, but the way they market, the types of disclosures that they make have to be fair and balanced. So we have made progress with the firms that we're looking at. We'll continue to look to see if there have been rule violations, particularly the advertising and supervision rules. Where we find those violations, we are going to apply pressure on these firms to do the buybacks.
Thank you. Thank you. And I want to commend the Attorney General and Secretary of State of Massachusetts. I think your efforts have led to some recoveries in other states. I think you've benefited people not only in your home state but across the United States. Some of the investigations, what you found.
Thank you very much. I will recognize myself for 5 minutes, and I would first like to begin by congratulating and commending all of you for the work that you have done in helping to make sure that the investors are made whole, that they're taken care of. That's good work, and I have a real appreciation for that. But I'd like to continue a little bit my questioning to ask about what I would consider preemptive work, or the kind of work that regulatory agencies do that avoid the problems in the first place. And of course, as we have entered this very difficult economic period, our own regulatory agencies that we are dealing with, not just SEC, but as we're taking a look at what we're confronted with now, we're wondering what can be done? What can be done to detect, to identify, to be able to determine through auditing when these problems are beginning to surface? Do we have to wait until we hear from investors who are now screaming and calling and accusing and very, very worried and very scared that they're going to lose everything? What can we do? What can you do to prevent? And let me start with SEC. I know you're enforcement, but what can be done before?
Well, thank you very much, and it's a very important question. To a certain extent, there's a part of me that thinks when enforcement gets involved, we've already missed some opportunities, and we would like not to miss those opportunities. But as Secretary Galvin noted, we're not so naive as to believe that we're not going to be necessary in some instances. As I think we've all talked about, the problem here is largely one of sales practice, and that is an important issue to address. It's important for all of us to focus on the training of sales reps and registered representatives who interact with customers, especially retail customers, to make sure they understand the products that they're selling. So that's one thing that we can focus on and that the firms can focus on. It can surely be something that we focus on during our examinations. It is also the case, as Secretary Galvin noted, that many of the issues that arise in the securities field arise due to conflicts of interest, and has been noted oftentimes in the past. We can't eliminate those conflicts, but we can disclose them, we can manage them, and we can train around them. I think one of the things that has been most dramatic here, as we've dug into the facts, is to see how little various registered representatives understood about the products that they were selling to their customers. We also do need to be alert to changes in markets and think about what we do when those changes occur. Secretary Galvin noted that in some instances, compensation was increased to encourage the sales of products. Well, I think one of the things we can surely encourage, that's a thing we can look for in examinations because that may change the incentives. We need to look at compensation structures, but it's also something firms can be alert to as they change their compensation practices to think about why they're doing it and what does that mean from a conflicts perspective. So,
well, let me just ask Ms. Merrill, keeping with this conversation, whether or not we'll discuss criminal penalties with me. What are the penalties? We discovered in the subprime meltdown that, for example, in California, there were two ways that real estate loan initiators could sell the products on the street. One was they could go through a licensing operation that we have, or the company, such as Countrywide, who is licensed, could then hire salespersons who did not have to go through the licensing examinations, and they put them on the street. And we're finding that not only did a lot of our citizens and consumers get seduced into products that they did not understand, that perhaps the salesperson didn't understand them or misrepresented, knowing that these arms and these other very exotic products were going to place these people at risk. So let's talk about penalties. What should the penalties be? What are they?
In FINRA, our penalties in these cases, in the auction rate cases, our whole settlement structure has been focused on getting money back to investors. As I mentioned, the firms that we've been focusing on are primarily the smaller downstream firms where we have not seen evidence of fraud. So without evidence of fraud, and we are enforcing our advertising rules and our supervision rules, we focus primarily on the remedy to customers. We do have fines associated with our cases today, as high as $1.65 million, down to about $250,000. Those fines are meant to give those firms credit for the fact that they stepped up and bought back these securities from their investors, and that's really been our motivation. The question that you asked before about what we can do to make sure this doesn't happen again, I assure you is a question that we have been asking ourselves internally at FINRA. We have a group called the Emerging Issues Group. We try to stay ahead of the curve on emerging issues. We talk to member firms. We talk to customers to find out how things are being marketed to them. We read the academic journals to see what is on the horizon. And we are very concerned not only about the cases that we brought today, but what other kinds of products are being marketed as cash alternatives, cash equivalents. Are they really cash equivalents? And is the way that these other types of products being marketed fair and balanced?
Thank you very much. Mr. Shays.
Thank you.
For 5 minutes. Thank you.
I'm pretty convinced that those who were marketing these in a way that didn't represent an accurate picture are going to pay a penalty, and I'm pretty content that that fact has been established. What I'm interested to know, and I guess I would ask the SEC, are auction rate securities going to disappear? Are they the same for the corporate, the student, and the muni? I mean, what is going to survive here? And then I'd like to ask the state folks if they had any sense. Is the state out of the picture in terms of student loan right now? I'm really concerned about student loans, and I hope I get something from this hearing that has me feel somewhat hopeful, and if not hopeful, at least a realistic picture of what's happening.
Well, thank you. It's an excellent and difficult question. First, to start where you started, and to reiterate some of the things that have already been talked about, Yes, the individuals who have been involved in bad behavior will be pursued. We have not yet brought individual cases, but we continue to pursue them. We will bring remedies against them to the extent we can establish cases, and that will also serve a deterrent purpose and help us avoid things in the future. As to the future of the auction rate securities markets, I think right now it is a difficult time for anyone to try to raise capital through an auction rate securities process, in part because of the failures that have been demonstrated in this market. You would have a very difficult time suggesting to an investor that these securities are liquid against the current the freezing up in February. So I think it is fair to say that raising capital through an auction rate securities process is difficult right now.
On all three areas, municipal, corporate, and student?
I believe in all three, and I have to say that I believe that student loans are the most difficult,
right,
because of the interest rate caps that are associated with student loan auction rate securities. Now, on the good news front, to the extent there is some good news in all this, there is liquidity that is being restored to these markets in certain instances, even in, to a limited extent, the student loan market. And people are engaged in some refinancing and whatnot. But I think the product itself is going to have to change to, if it's going to be marketed as a liquid investment, developments to assure that liquidity are going to have.
Okay, and we're really talking, this is impacting the state loans, student loans, not the federal. Can either of you?
I think it's primarily affecting student loan authorities, which most states have established, many states have established. I can tell you that in Massachusetts, the Massachusetts Educational Funding Loan Association had suspended loans back in July, causing great difficulty. Fortunately, just yesterday or the day before, they were able to announce that they have secured some funding. I think the general point regarding auction rates is probably true, that I think not just because of the bad press, if you will, associated with the auction rate, but that the whole concept of this auction has been discredited because the auction was in many respects a fantasy. It never really happened.
Right.
I think the bigger issue as far as financing educational funds is going to have to be approached from a number of different ways. One way possibly is to have states, which was not the case specifically in Massachusetts, but was suggested, have the states stand behind it with their state credit to verify for the authority to be able to go out and solicit some sort of financing. Others have suggested, and I found this an appealing thought, I suppose it wouldn't apply for everybody, but that some of the large endowments of educational institutions ought to be sought out to be invested to support these funds. Many educational institutions enjoy very large endowments. I know in my state, and I believe in yours, they may well also be a source.
Right.
I mean, these endowments...
bottom line is, though, you agree this is an issue that we have to pay a lot of attention.
Yes, I would certainly agree. I think that for many students right now, this is a very critical time.
I just want to ask one last question, and it's a real curiosity to me. If this has been an instrument for 24 years, have false advertising occurred all throughout 24 years?
I rather doubt it. I can't answer you decisively, but I believe that there became a practice, and because these instruments were successful for so many years in it, they worked for different consumers. They worked for the institutions who was trying to get some advantage with their debt. They worked for individuals who were looking for a slightly better rate. They did work, and as a result of the credit freeze-up, as a result of the market starting to fall apart, they indeed became inoperative. What we became involved in, and I think it's already been referred to here by myself and others, is that at some point the market makers became aware of that, and instead of dealing with it in an upfront way, they went ahead and deceived people.
Yeah, that point was made. I'm sorry,
Yeah.
and I appreciate you emphasizing it. Thank you all. Thank you, Madam.
Thank you very much, Ms. Maloney, for 5 minutes.
Thank you very much, and I thank all the panelists. I'd like to ask Ms. Thompson and the SEC, when you were censured in 2006, why did you not impose transparency in the auctions then? And as I understand, there was an investigation in 2004. And why did you not require disclosure, just like the U.S. Treasury does, on all of its auctions?
Thank you for that question, and indeed there was a requirement of disclosure at that time. The investigation into auction rates that resulted in the actions in 2006 focused on
Excuse me, there was a disclosure requirement, a transparency requirement in 2004?
in 2006 as
Could,
a result.
could the committee get a copy of that? Did it
Sure.
talk about the fees and the fact that it's not cash and that it's really a hazard to people to get into?
Excuse me, then I misunderstood. The disclosure that was required in 2006 and the investigation that led up to the cases in 2006 had to do with how the auctions were conducted and the way the firms conducted the auctions, which included the fact that the firms went into those auctions and in some cases sort of gamed the system to get the price sort of in the sweet spot, if you will.
So you were looking at how the firms were gaming the system. Was there any disclosure or transparency that was given to issuers and investors to tell them about the risks? My constituents told me that they were told this is good as cash. Then they found out they can't get their cash. So they feel they were manipulated or treated criminally. And I just want to know, do we have any transparency now letting buyers know about the risks that are involved? And if not, why don't we start SEC rulemaking immediately so that this type of scam doesn't continue?
There are certain kinds of disclosure that are associated with this, and there's certain disclosures that did not go to investors, as we've talked about. Investors, as a result of our action in 2006, for the firms who were part of that process, are given disclosure or have the opportunity to see disclosure about how the auctions operate.
But are they told that it's not cash? That they are, what I'm told, they were told it's cash, good as cash. It's not. Are your transparency telling them how risky it is, how many billions of dollars have been lost, how taxpayers have been hurt, localities have been hurt? Are you disclosing that? And if not, why are you not disclosing that now in the billions of auctions that are currently being conducted each day?
I think it's fair to say that as a result of this investigation and focusing on the sales practices, it is clear that investors were not told about the potential liquidity risk. And that
are you telling them now?
Well, right now, there is no requirement for sort of paper disclosure or written disclosure with respect to this. Indeed, most of the...
Why not? We know that millions and millions of dollars have been lost. They've been 2 suits settled. And we know that, and I want to bring into this and congratulate the state of Massachusetts for your 2008 lawsuit where the Secretary of State, I find this astonishing, really astonishing. The Secretary of State revealed that going back to 2006, nearly 85% of the auction would have failed or produced different results without the single broker's intervention. So whatever are we doing to stop this conflict of interest? And the SEC, I got to tell you, I have constituents who've lost their jobs. They tell me because the SEC didn't act quick enough to stop the naked shorts. And I'm glad that you have finally stopped it. Maybe it can save some other firms. But we know about this scandal now. And why are we not telling clients and individuals and investors and issuers about this horror that it's not cash? They can lose all their money. They will not get their hands on the money, not to mention the taxpayers that are supporting these institutions that go into them. They are not being made whole. So a lot of people are losing in this, and I think they should be told. Why aren't we telling them?
The disclosure obligation is on those who are selling the product, and it is a secondary sale by and large.
Well, why aren't you requiring them to tell the innocent people who are being lied to? They're telling me they were lied to. Why don't we get an SEC rule in tomorrow that says don't lie to investors and to consumers? Let them know that it's not cash, that they can lose their money, that there have been 2 lawsuits that why are we going to continue? We're in a financial crisis. We cannot continue financial practices that lose money, hurt communities, hurt consumers, hurt investors.
Ms. Maloney, let's hear
My
a
time has
response.
expired.
No, we want to hear a response in your time.
Pardon me?
You asked questions that have not been answered yet, would you?
We do have rules, and in fact, the fact that we are able to bring the cases that we are bringing right now demonstrates that the registered reps cannot lie to their clients. They cannot tell them false information. They cannot represent something to be liquid that isn't, and that is what we're doing with our law enforcement efforts here.
I would like a point of clarification in writing. Constituents are telling me that they're being told that they can get their cash back. The state of Massachusetts went to court over this, that they can't get their cash back. Some of them to this day can't get their cash back. So are we clearly telling people in the disclosure that this is not cash, that you can lose your money? If just get back to us in writing and exactly what you're doing.
But the actions here, what happened was people were told information that was false, and that's why we're bringing the actions that we're bringing, and that's why we were able to get the resolutions that we're getting. But you're absolutely right. Investors should not be lied to, and brokers and registered rep who lie to them should be accountable for those lies.
Thank you very much. Mr. Nagelbauer.
Thank you. I'm going to deviate a little bit from what we've been talking about, and Director Thompson, can you, I think last year the SEC repealed the uptick rule. And I have had conversations with a lot of folks here recently that tell me that really with the change of that it almost becomes a self-fulfilling prophecy that now that people are shorting on a downtick, and that you keep shorting in the ticks. And one of the reasons that the uptick rule was actually put in place back in the 30s was to bring some stability to the markets. Is it time to reconsider the repeal of that uptick rule and in this environment that we're in right now?
Well, as you know, I do enforcement, but I have to say that the Commission has obviously been extraordinarily busy considering the substantive area that surrounds the uptick rule. So, for example, the rules that went into place this morning at 12:01 that relate to short sales, the hard delivery requirement, the exclusion of certain exceptions under Reg Show, an additional anti-fraud rule, all of which went into effect at 12:01 today. The requirements that we're going to that are going into effect to report short positions on an extremely timely basis, as well as the enforcement initiatives that will be that are underway and will continue to be underway. I think they all demonstrate the Commission's acute focus on the subject matter of how to address abusive trading.
And so back to my original question, though, do you think it is appropriate at this time to review that rule?
I think the Commission is reviewing all rules and reviewing all options to address market conditions.
As we are requiring a number of these firms to repurchase a number of these auction rate securities, are we in any way possibly jeopardizing the liquidity of some of those firms by putting this enforcement action on them and maybe creating some other problems?
As I mentioned, it was something that we took into account as we thought about the remedy and how to get to the remedy. I mean, first and foremost, I think we were all focused on restoring liquidity to investors who had done nothing wrong and found themselves without liquidity. But the cost of restoring liquidity is, as you suggest, quite high. So we worked among ourselves. We talked to, certainly at the SEC, we talked to our experts in the Division of Trading and Markets to understand what the firms, their position and what they could undertake, and on the timetable they could undertake it. We talked to the firms themselves who reach these agreements. Everything we're talking about is something that firms agreed to, and these are very sophisticated firms, so we expected them to be worrying about their capacity as well. We also, through our Division of Trading and Markets, reached out to other federal regulators, the Fed and Treasury, to understand the positions of the firms. Baked into these resolutions, you will see things like timetables. And I think at a certain level, all things being equal, you want liquidity restored yesterday and the day before and the day before that. But I think the fact that there are timetables built into the settlements reflects the fact that people were taking into account the capacity, if you will, of the firms. So I think we have worked very hard to get to a resolution that is good for investors, but also takes into account the costs.
And are there auction rate securities that have begun to trade again, and auctions have been successful?
Yes.
And where are there a particular sector where that has been more prevalent, or is it
Well, I know the one that's hardest hit is student loan, and the others are coming back, and others are some of the issues are being restructured, so that essentially they're being redeemed and restructured in different kind of financing.
I yield back. Thank you.
Thank you very much, Mr. Watt.
Thank the Chairman, Chair Pro Tem for the recognition. I want to get to a point which I think Mr. Galvin was about to get to when he almost ran out of time. At least I hope that's where he was about to get to. The thing that surprised me as the chair of the oversight subcommittee of this committee more than anything else is two reactions following this whole big market thing, including this part of the meltdown. One is that everybody is looking for somebody to blame, and there is a strong desire for retribution. I want to punish somebody. Why haven't we put somebody in jail? And that reflects itself with me as chair of the subcommittee on oversight, because people keep asking me to have hearings about what created this problem and who's at fault. I've quite honestly and publicly been very vocal that I have no intention of having that kind of hearing, unless the chair, of course, asked me to have that kind of hearing, because I think we need to be focused more on getting the heck out of this crisis right now than who was to blame for it or punishment. I mean, you know, we don't punish in the legislative branch anyway. Some prosecutor needs to go out there and investigate and indict somebody, and there are a bunch of people out there that I think qualify for that, but that's not my job. And even the suggestions about reform, really, that I have seen, haven't been suggestions about reform. They've been about restructuring the regulatory system, who's in charge rather than what the person. I mean, we had regulators regulating all of this stuff. And if they had been competing to do their job rather than competing to protect their particular constituencies in their industries, we probably would have avoided a lot of this stuff. So this whole restructuring thing about let's name a new regulator seems to me to beg the question, what is the regulator going to do? And even all of this discussion this morning, except when Mr. Galvin was about to get to it and ran out of time, hadn't gotten to that question. You know, we've talked about who was at fault, who did what bad, you know. We need to restructure, we need to realign the regulation. And the single question that I keep asking, and I'd like each one of you just to tell me one thing that you would do in terms of a specific regulation that would prohibit this that would stop this from happening in the future. Because we've got to, we got to do something that, you know, we're already here. Sure, we got to dig ourselves out of the ditch. But I'm looking for something that will stop future crises of this kind from happening. I've given my speech now. Just one thing. Don't tell me realign the regulation, because that doesn't tell me what that new regulator is going to do. Tell me what whoever the regulator is, what they ought to be doing to prevent this from happening again in your little area of the world here. Please, just give me one suggestion.
I think we ought to do more of what we did in this particular case, which is to work together and bring swift law enforcement action to those who have engaged in wrongdoing.
Unresponsive, I'm sorry. Go ahead, Ms. Merrill.
I wouldn't write a new rule. I think we have a lot of regulations that cover what we saw here, and that's why we've been able to bring the investigations and the cases that we've brought. What you're asking is, how can we keep from having to bring an action? How can we keep there from being this kind of thing again? And there, I think we've been looking internally at when we go out into firms and do our
Ma'am, don't tell me what you've been doing. Tell me one thing that you would do to stop this from happening in the future, please.
I would question firms at our on-site examinations about how they're actually marketing cash equivalents over the phone to their constituents, to their customers. And not just look at the script, but question people about what they're saying. Are they disclosing the risk?
Mr. Galvin, I'm sorry.
Thank you. If I were to summarize in one idea, it would be to revisit the idea whether the significant or substantial repeal of Glass-Steagall in the late 90s was a good idea. I think by taking down the wall that existed between investing and banking, you open the door for many conflicts. And I think if we're going to be serious about regulation, you have to have rules that make some sense, and I think this one didn't, and it's time to change it again.
Ms. Coakley.
Two things. Two things, and I think they're included in Secretary Galvin's testimony. I think you have to prohibit some conflicts of interest now, and I think you have to require disclosure on others. And the second piece is, I think you have to look at the financial incentive piece. You have to prohibit some of them, and you have to disclose others. That's been at the root of the subprime mortgage problem. It's at the root of this. They all come from the same lack of appropriate disclosure by those who are involved in this. And I say this as an enforcer. I'm not a regulatory body. Secretary Galvin is. But we can do the autopsy on what happened in the subprime mortgage. We can do the autopsy on what happened here. And I think Secretary Galvin very succinctly says we need to change those rules, how people play this game. Because otherwise we're going to be back here in 5 years or 10 years with all of these enforcement actions.
I yield back. Thank you.
Thank you very much. Ms. Capito for 5 minutes.
Thank you, Madam Chair. First of all, before I begin, I would like to ask unanimous consent to enter into the record prepared statements submitted by the Municipal Securities Rulemaking Board and the Regional Bond Dealers Association.
Without objection, such is the order.
Thank you. I'd like to bring the questions down more on a street level, I guess. Could you quantify just approximately how many holders of these kinds of securities would have been entities and how many would have been individuals?
If I may, I think it varied by firm. Some firms tended to sell a higher percentage of theirs to institutions, nonprofits, for instance. Other firms had a higher percentage that were amongst individuals. That's why when we worked out these settlements, we focused on different categories, such as so-called retail investors. Those were individuals, small businesses, which we, again, it varied from case to case, but we set a dollar amount, usually about 10 million, I think was the number we were working with. And then the larger so-called institutional investors, which was in most of the settlements were the last category. The theory was that the smaller people, the individuals, were probably less sophisticated and also presumably more in need of the money, whereas the theory was, fair or unfair, that the institutions were in a better position to long time. There is a best efforts requirement on most of these agreements.
I have some statistics that we were able to gather through our survey of over 200 firms. 43% of auction rate securities were held in retail customer accounts. Another 21% were held by customers who are considered high net worth individuals, and 37% were held by institutional accounts.
Okay, great.
And to add something else, we believe that while there were more retail customers in terms of numbers of customers, that the holdings were about 50-50 between retail customers and institutional customers.
Okay, another question I have is, for the individual who's holding a bond, is there can you make a distinction, if somebody's watching this today and they're holding something in their account that they thought was very solid, it's a state instrument or something that was, how can you make a distinction for them between what they're hearing today and what they're holding now?
Well, I think you raise a very good point, and something that we ought to mention is that by and large, the underlying securities on all these auction rate securities remain solid. That is, the expectation is that the bond will pay off according to its terms. What has really been lost is the liquidity, which was what it was marketed to be.
So you couldn't turn around and
exactly. People thought that they could immediately turn this investment,
even if it had a 30-year.
Even if it was a 30-year maturity.
Okay, let me switch gears a little bit here then. So the institutions that, or the folks that have been issuing these, universities, I mean, I represent a small area, government entities. How is their liquidity now when they're going out of the market and trying to build a new wing to the hospital, create a new ambulance authority, or whatever transportation or infrastructure? Where is that now? And that really troubles me because, we want to move forward, obviously, for a lot of different reasons, but, these are a lot of jobs involved in a lot of this issuance as well.
Well, I think this is as a fundraising vehicle, a capital raising vehicle is not as attractive as it once was. Even at the time people were using auction rate securities to raise capital, there were alternatives. And underwriting, for example, that was more expensive, but I think across the board, not just for municipalities, but for just about anybody trying to raise capital, it's a difficult and more expensive environment than it was.
So it's tight.
It's tight.
Okay, I noticed too in our briefing papers that the institutions who were actually, or the issuers of these auction rate securities were allowed to permit it in February to begin buying their own paper, essentially. Is that still going on? And what is the situation in terms of, I mean, it seems to me that could be almost a double hit in some ways.
Well, it was allowed. Okay, here I have numbers here. The public sector borrowers have now refinanced or made plans to refinance at least $103.7 billion of the original outstanding $166 billion in municipal auction rate debt, or 62% according to data which was compiled by Bloomberg. So that answers your prior question. The rule that was put in place in March is still in effect, as I understand it, and I think I'm going to have to get back to you on the impact of that.
Okay. Thank you.
Thank you very much. Mr. Scott, we're going to take you one from Mr. Royce, and then we're going to go vote, and we'll return.
Okay, thank you very much. Let me start off by asking, put a quantity around this. There's $300 billion worth of investor funds that are still locked up. Is that right?
No, they're not still locked up today. That number has shrunk dramatically over the last few months, thanks to the efforts of the regulators and also thanks to some restructuring on the part of the issuers. I think we're down into the 100 billions now, still quite a lot.
Okay, and many of these are small investors.
That's right.
And as we got into this, basically the auction rate security market basically sets, as it was set up, basically catered to your smaller individual investor. And as the crisis kind of got worse and it kind of drifted in and the big banks became to be more relied upon as participants. And as many of these smaller investors are now unable to sell these liquid securities, they're having to look elsewhere for satisfaction. But there really aren't many places that they can go for help. Is that correct?
I think the market actually started out as a more institutional market, and over time, the issuers allowed a smaller amount to be the minimum that you could invest in an auction rate security. And once that amount got down to about $25,000, that's when you started to see more retail investors buying the product and the broker-dealer firms marketing to more retail investors. Those investors do, of course, have other options of where to put their money. This was marketed as, by many firms as a cash equivalent, which we think was not a fair and balanced way to market it, particularly firms that didn't highlight the liquidity risk if the auctions failed.
So many of them, their course of action was be as some of the brokerage firms and some of the larger investors were to file lawsuits. And these lawsuits have been settled with them. I'm interested to know, given the smaller investor, how many lawsuits have been filed by small investors in this debacle?
We have about 300 claims that have been filed in the FINRA arbitration forum by investors. Some of those undoubtedly will be dropped because some of those investors will be part of the buybacks that have been announced today and previous buybacks that have been announced by other regulators. But certainly there are small institutional investors whose firms have not yet offered the buyback. We have the FINRA arbitration forum available for them, and we've set up special procedures to make sure that those claims are being looked at fairly and effectively.
And it's fair to assume that many of the financial institutions, brokerage firms who represent these smaller investors, one could say played a role in this. Are they playing a role in helping these small investors? And what are the regulators doing to help the small investors? My information tells me that the lawsuit option has not been that good for smaller investors because to file a lawsuit costs a lot of money in many cases. So that's not an alternative. And my picture of this is some of them are just left swinging in the wind here. So what are we doing? Are the brokerage houses, or many of them, who might have inadvertently helped get the small investor in the mess as it is, are they working? Are they doing some things? And then what are the regulators doing to help these small investors?
What we've been doing at FINRA really from the beginning is focusing on getting money back to retail investors. Our enforcement investigations, I believe, have provided the incentive for firms to step up to the plate and offer buybacks to their customers. We have 5 of those cases today. $1.8 billion worth of auction rate securities will be bought back. Other regulators, the people on the panel with me today, have other settlements that have freed up over $40 billion, I believe, in securities, auction rate securities. So we are focusing on getting those funds back. I agree with you that the best solution is to have the firms do the buybacks as quickly as possible. But we do have the arbitration form there for customers whose firms have not yet entered into those settlements.
Thank you very much.
I think it's fair to say that the settlements to date and including the ones that FINRA just announced. If you focus on retail investor, the smaller investor, a large majority of those investors will have the opportunity to get cash back, 100 cents on the dollar, all of their sort of interest paid to date, as well as an opportunity to recover any consequential damages through a FINRA process that is quite streamlined without ever having to file a lawsuit.
That's good to hear. Thank you.
Thank you very much. We have 5 minutes to get to the floor. Mr. Royce has a burning question.
Just
to
one.
ask.
Director Thompson, the settlements have not specified how individuals' funds held in fiduciary accounts and invested short-term in student loan auction rate securities and now due back to the individual investor, or for closing an individual transaction, how that's to be handled. And the investment banks who sold the student loan auction rate securities for short-term investment are unsure if they're to redeem these smaller individual investments held in fiduciary accounts on the front end of their settlements. For example, should they be treated the same as any individual holding the security directly? That's my short question.
And our objective is to get the small retail investor redeemed early and first, and we are working out those details as we finalize these settlements.
And in terms of this fiduciary account situation, that would be an affirmative, or?
It'll be something that we're going to address as we finalize it.
Thank you. Thank you, Madam Chair.
Thank you very much. Panel, you have been very patient and very good. However, we do have other members who have questions that they would like to ask. We have to go to the floor. We have 2 votes. One is a 15-minute vote. The other is a 5-minute vote. If we go and take these votes and take about 5 minutes to get back, we should be back in 25 minutes. So I'd like to ask you to please remain so that our other members will have an opportunity to ask their questions. Thank you very much.
Thank you.